Imagine you run an airline and fuel is a huge expense. If the price of jet fuel goes up, your costs skyrocket, which would eat into your profits. To protect themselves from this, airlines often use something called a derivative. Derivatives are financial contracts whose value is derived from an underlying asset. This asset can be anything from stocks and bonds to commodities and currencies. In this case, a derivative is like buying insurance for the price of fuel. By using a derivative, an airline can agree to buy fuel at a specific price in the future. If the price of fuel goes up, they're protected because they are already locked in at a lower price. It's a way to manage risk and keep costs under control. While they can be complex, derivatives play a crucial role in our modern financial system. They serve as tools for both risk management and speculation, and also allow businesses and investors to hedge against potential losses. If all of this sounds like mumbo jumbo to you, don't worry. In today's video, we're going to explain derivatives in plain language so you can understand them for yourself. Who knows? Maybe one day you will use them. With that said, welcome to Money Movers Academy, where purpose and profit align. We are an educational media company that promotes financial literacy for personal, professional, and community development. We're here to help you make $1 and a difference, so make sure to like our videos and subscribe to our channel to get more content like this. You can also visit us online at www.moneymoversacademy.com for courses, resources, and opportunities. Thanks in advance for your support. All right, let's jump into today's video. So, two primary reasons why businesses use derivatives is because of concepts called hedging and speculation. Hedging is a risk management strategy aimed at protecting against potential losses. The airline scenario mentioned in the introduction is an example of hedging. The airline would buy fuel futures to lock in a certain price, therefore protecting them against the risk of rising oil prices. This is what makes hedging different from speculation. The goal of hedging is to minimize potential losses rather than maximizing profits. Speculation, on the other hand, is about taking a calculated risk with the hope of profiting from price movements. It is basically betting on something. It's when you predict what will happen to something in the future, like the price of a stock or a commodity, and then you invest money based on that guess. If your guess is right, you can make money. But if you're wrong, you can lose money. It's a risky game, but it can also be very rewarding if you play your cards right. Let's explore some examples of hedging. Futures contracts. A futures contract is like a bet on the price of something at a specific time in the future. Let's say you're a farmer growing wheat. You want to know how much you'll get for your crop when it's ready in 6 months. A futures contract lets you lock in a price today for the wheat you'll sell in the future. This protects you from price drops. But if the price of wheat goes up, you'll miss out on that extra money. So, while futures contracts can be helpful for managing risk, they also involve a bit of gambling on future prices. Options contracts. Think of an option as a gambling ticket for a stock's price. You don't have to buy the stock itself, but you can bet on whether its price will go up or down. If you think a stock price will rise, you can buy a call option. This gives you the right, but not the obligation, to buy the stock at a specific price in the future. If the price goes up, you can buy the stock at the lower price and sell it at a higher market price, making a profit. But if the price goes down, you can simply let that option expire worthless. Swaps, or trading places. Imagine you have a mortgage with a fixed interest rate, but interest rates are dropping. A swap could help. You might agree to swap your fixed interest payments for someone else's variable interest payments. If interest rates keep falling, you'll end up paying less overall. It's like trading one type of payment for another. Swaps are often used by big companies and banks to manage their financial risks. Forward contracts. Imagine you run a small bakery and need a steady supply of flour. Instead of buying flour each week and hoping the price doesn't skyrocket, you can make a deal with a farmer. You agree to buy a specific amount of flour from them at a set price 6 months from now. This is a forward contract. It helps both of you plan ahead. You know your flour cost, and the farmer has a guaranteed buyer. But unlike futures, these deals are made directly between two parties, not on an open market. Credit default swaps. Okay, let's say you lend money to a friend. You're worried they may not pay you back. So, you ask an insurance company to cover your losses if your friend defaults. That's basically a credit default swap. It's like insurance for your loans. In the financial world, investors often lend money to companies by buying their bonds. A credit default swap is a way for them to protect themselves if that company goes bankrupt. It's a contract where one party pays a fee to another in exchange for protection against a default. If the company defaults, the insurance provider pays out. Okay, are you still there? Great. We hope that gave you a better idea about your hedging options and what they can be used for. Before we explore speculation options, now would be a great time to click the like and subscribe buttons. Thanks in advance. We appreciate you. All right, now let's explore speculation options. The first one is foreign exchange derivatives. Now, imagine you run a business that imports goods from Japan. You need to pay in Japanese yen. If the yen gets stronger compared to your local currency, your costs will go up. To protect yourself from this, you can use a foreign exchange derivative. It's like buying insurance against currency fluctuations. You can lock in a specific exchange rate for a future date, protecting your business from unexpected costs. But these derivatives aren't just for businesses. People can also use them to speculate on currency movements. If you think the euro will strengthen against the dollar, you might buy a derivative that lets you profit from that. It's like placing a bet on which currency will come out on top. Now, short selling. Imagine you think a company's stock price is going to drop. Instead of buying the stock and hoping it goes down, which would be a loss, you can actually bet against it. This is called short selling. Here's how it works. You borrow shares of the stock from someone, like a broker. Then you sell those borrowed shares. If the stock price drops, you buy back the shares at the lower price and return them to the person from whom you borrowed. The difference between the higher selling price and the lower buying price is your profit. Next, contracts for difference, or betting on price changes. Okay, let's say you think the price of a stock like Apple is going to go up. Instead of buying the actual stock, you can use a contract for difference. This is a bet on whether the stock price will increase or decrease. You agree to pay the difference between the price of the stock when you enter the contract and the price when you exit it. If the price goes up, you make money. If the price goes down, you lose money. It's like betting on a horse race, but instead of horses, you're betting on stock prices. Contracts for difference can be risky because you can lose more money than you initially invested. It's important to understand the risks before getting involved. Real estate speculation. Real estate speculation is like gambling on property values. You buy a property hoping its value will go up over time. Instead of stocks or futures, your investment is in physical land and buildings. For example, you might buy a house in a neighborhood you think is up and coming. You fix it up a bit, then sell it for a profit. This is called flipping. Or you might buy rental properties, collecting rent while hoping the property value increases. But you have to remember, like any investment, real estate can also go down in value. So, it's important to do your research and understand the market before taking the plunge. Initial public offerings. An IPO, or initial public offering, is when a private company offers shares of its stock to the public for the first time. It's like opening a new restaurant and inviting everyone to be a part owner. When a company goes public, it's often because they need to raise money to grow their business. By selling shares, they get cash to expand, hire more people, or develop more products. Investors who buy these shares become part owners of the company and hope to make money if the company's value increases. But it's important to remember that IPOs are not a guaranteed success. Some companies soar after going public, while others flop. That's the nature of business. Lastly, day trading. Day trading is like trying to catch a wave. You buy and sell stocks super fast, hoping to make small profits on lots of trades. It's like a high-speed game of buying low and selling high over and over again. You need to be quick on your feet and have a good understanding of market trends, but it's also really risky. The market can change in seconds, and you can lose money just as fast as you make it. It's not for everyone, and most people who try it end up losing money. However, there are people who make money too, and lots of it. If you're wired for this type of work, it's a great way to make money daily. All right, there are plenty of other ways to engage in derivatives, but we think this is a good introduction for you. So, that's our video for today. What are your thoughts about derivatives? Do you have any experience with them? Let us know in the comments. Also, make sure to subscribe to our channel and hit the like button to keep getting content like this. We thank you in advance and appreciate you more than you know. See you next time.